Hi, good morning, good afternoon, good evening, everyone. Now, before I begin, just want to be sure that you guys can see my face, right? More importantly, the screen. Okay, you guys should be looking at FP Markets website, and also you guys can hear me loud and clear. All right, if you guys can do all of that, please drop a comment in the question box. All right, thanks a lot, Gerald. Okay, fantastic. Right, so today, okay, we will be covering introduction to trend indicators. And before I begin, just a bit of administrative housekeeping stuff. For all upcoming webinar, you can actually go to fpmarkets.com, resources. Under the resources tab, you can actually go to education column, and there's this webinars that you click on it. All right, and it will show you all upcoming webinars, right? So today is introduction to trend indicators. Next week, right, is introduction to trading psychology, and I will again be covering the importance of a trading plan, right, the basics. Okay, so all the webinars are right there. Okay, so with that, let's begin. All right, hi Eric. Okay, thanks for the reply. Today we'll be covering introduction to trend indicators. Now, we have a bit to cover, so I will do my best to try to cover it as extensively as I can and as detailed as I can, right? But if there's time, I will also show you guys how we can apply such indicators to the charts. Okay, so before we begin, just a bit of a disclaimer. Understand that the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Now, FP Markets has made every effort to ensure the accuracy of information at the date of publication. However, FP Markets does not give any warranty or representation as to the accuracy, reliability, or completeness of the information contained in this material. However, it is down to my duty as the presenter to really give you guys as accurate as possible the information that has been provided in this webinar, in this presentation, and you guys can rest assured that all information presented in this webinar is accurate at time of presentation. All right, so as with all the webinars that I cover, right, if you guys have any questions at all, feel free to stop me in the middle of my presentation, and I will do my best to give you guys an answer. All right. Okay, so for today's presentation, right, very quickly, we will be covering what is a trend, right? Before we understand what trend indicators are, we need to first and foremost know what is a trend, right? And then we also need to start, then we'll be looking at the popular trend indicators. Okay, I have provided 5, right? It is a bit tough to find 5 popular trend indicators because in my personal opinion, there are only 2 most popular trend indicators. The rest a bit debatable. All right, and then if time permits, okay, we will try to incorporate a bit of show you guys how to incorporate indicators into our analysis. And also, as a sort of a little bonus, if there's additional time, I will also show you guys how I actually apply moving average to my analysis. So I employ this thing called the natural moving average. All right, so I really hope to be able to share that with you guys. Okay. So before I explain a bit more on trends, all right, we have quite a number of people here as attendees. I just want to get a sense, right, or what is the experience, okay, the experience level that you guys have with trading, right, trading or investing. Okay, I understand that this is really more for beginners because it's been put there on the website, all right, but I just really want to get a sense of the experience level in this room so that I know, okay, whether I can tailor it to be a bit deeper or a bit more surface level stuff. All right, so you guys, okay, so we have some saying brand new. not an issue. Okay, so advanced. All right, so definitely a very wide spectrum. Okay, so yeah, we have some saying finally returning to trading. Okay, yeah, even in my experience, okay, over the years that I've had, I've left trading and came back quite a number of times. Right, it can get frustrating, but don't give up. Okay, don't give up. All right, fantastic. So really a broad spectrum of experience that we have over here. So I will do my best. If this is really too simple, okay, I ask for your patience and understanding. Okay, it's not very easy to cater to everyone. If it's a bit too deep, okay, not to worry. You guys can actually send in questions. Okay. Okay, so yeah, we hope to be able to help up the level of application, right? For me, it's always about application of technical analysis. It's not just about the knowledge. Okay, having knowledge is important, right? But knowledge alone is not sufficient. All right, so let's get right into it. So what is a trend? Okay, so a trend forms when price moves strongly in a given direction, right? And the keyword that I put here is persistently. Okay, you realize that I don't have any I don't really put a time frame because trends are generally subjective in nature, and it's really up to each trader's definition, right? So you can be a swing trader like myself, okay, and a trend for you will be something that you look at on the weekly, on the daily, and on the monthly, right? You can be a trend trader, so you're just really looking at a monthly and the yearly. Okay, and if you're intraday trader, then you're probably looking at a trend on the daily, right? So trends are really subjective. Okay, that having gone through the entire CMT program and CFTe program, right? There is no real definition of what a trend is. Okay, so it's really up to each of your own definition. However, okay, you guys need to know that the idea of a trend is that the moment we recognize that there is a trend, okay, that forms our bias for a trading decision. Okay, so you guys would probably have heard the famous saying, right? A trend is your friend, right? A trend is your friend until it ends. Okay, but I would also like to say that it is generally understood in the trading and investing circle that a price trend, when we say that a price is trending, right? Markets are trending. Okay, we're seeing price trend on the charts. All right, people tend to attribute it to a longer term characteristic. Okay, it is not a short term intraday or even a 5-minute, 10-minute sort of thing, right? Trends are tend to be attributed to a longer term time frame. Okay, and of course, according to the father of modern day technical analysis, Charles Dow, right? According to Dow theory, trends can be classified into primary, secondary, and minor. So of course, the primary trend is referring to the really long-term time frame. All right, the secondary trend is referring to a slightly shorter time frame, and then the minor is referring to the intraday or the daily time frame. So at the time when Charles Dow was around, when he developed this Dow theory, there's no such thing as intraday, right? It really was just daily prices, and that's about it. Okay, so minor, he would be referring, to be very specific, he will be referring to the daily trend. Okay, all able to follow so far? So I don't really want to keep this too wordy, so I'll show you guys in terms of the picture, right? In terms of the picture. Okay, so I have put a very simple picture over here, right? It is so simple that it's really just a couple of lines on the screen. All right, but really this is a very important concept that you guys need to understand when it comes to understanding what is a trend. Okay, so let me get the drawing tool out. So let's first look at the uptrend. Okay, now how do we know that a market is in an uptrend, right? When the market makes a series of higher highs and higher lows, right? So when there's this persistent action of making a series of higher highs and higher lows, then we can say that the market is in an uptrend. Now the opposite is true also for the downtrend, right? The market is in a downtrend when we say the market is trending downwards, all right, or the trend of the market is downwards, right? That is when we see the markets making lower lows and lower highs. Okay, so not trying to fluff you guys, right? But really, this is really important in understanding market trends and market structure. So now that we know that what are the characteristics of an uptrend and a downtrend, okay, let's go back to what Charles Dow was saying, that there are primary, secondary, and minor trends. So imagine this uptrend movement right now, okay, is the monthly chart. It's a monthly time frame. So this would be what Charles Dow is referring to as the primary trend. Okay. Now, if we were to use the basing this on the fractal nature of the markets, all right. So fractal markets hypothesis, it is a thing. You guys can go look it up on Google. Fractal markets hypothesis. All right. In this primary trend, okay, when we zoom in on each of the when we zoom into the trend, we are able to see secondary trends. Okay, so within the primary trend, which is upwards, okay, the markets are also making, okay, small upwards and pullbacks. All right, they're making small upwards upwards trend with a slight pullback, right? Even when markets are coming down and pulling back on the monthly time frame, all right, we're still seeing, okay, markets making trends. All right, so this blue line here could very well be the weekly chart. Okay, now that is the secondary trend. Okay, and let's zoom in even lower. All right, let's look at the minor trend, right? So the minor trend within this uptrend, okay, within the secondary trend, okay, we see minor trends as well. Okay, all right, so you guys get an idea. Okay, so when I do get questions like, hey, you know, Isaac, you know, the market is trending upwards, why are you shorting, right? Then as a trader, you need to be very clear whether you're shorting, okay, just to play the short-term pullback, or you're shorting because the trend is reversing. Okay, so for me personally, what I tend to do is when prices are trending strongly upwards on the higher time frame, okay, and if I'm playing the pullback on the lower time frame, say maybe the daily or the 4 hours, right, my position size is slightly smaller, right? So I reduce my risk by a bit. Okay, so this primary, secondary, and minor, okay, applies to both the uptrend and the downtrend. Okay. Okay, Eric saying that he can't see my screen, only me on my camera. Is there something? Okay, I just want to be sure that you guys can see my screen. You should be able to see the PowerPoint slides. Okay, it's more important to see the slides than seeing my face, right? My face will not be able to help you guys understand. Okay, so some of you are able to see. So unfortunately, Eric, I'm thinking it could be an issue on your side. Maybe you can log out and then log back in again, right? So I will pause a bit, okay, and give you some time to do just that. Yeah, okay, because prior to coming online, going live, I've actually also done audio and video check with the FP Markets team, right? So to ensure that it doesn't give you guys any problems. Okay, so back to this. All right, I really hope you guys understand the trends. Okay, how to identify when markets are in an uptrend or downtrend. Okay, this will really help you guys identify it on the chart. Okay, a lot of people tend to just throw in trend indicators and say that, okay, oh, it's above moving average, we're upwards trending, it's below moving average, we're downwards trending. My question to them is, what time frame are you on, right? Are you on a monthly, are you on a weekly, are you on a daily? You're just looking at one static time frame, but you need to start looking at multiple time frame, right? So when it comes to trading, multiple time frame in itself is a sort of a discipline that should be employed. It should be second nature to the analyst. It should also be second nature to the trader. Okay, so I hope Eric is able to come back in and also see the slides. All right, so now that we understand what is a trend, let's move on to the meat patty, right? The juicy portion of today's presentation. Okay, what are some of the popular trend indicators? Now, before I go through the popular trend indicators, I need to just point out some things, right? The main definition, okay, the main definition of okay, fantastic. Okay, Eric, you didn't miss anything. Just switch to a new slide. All right. So the main definition of trend indicators is really that trend indicators, what they do is just to help the trader or the analyst confirm that a trend is either in progress or the trend is reversing. Okay, so it helps to confirm, right? It doesn't point out that the trend is currently reversing, okay, or the trend is going to reverse, right? It doesn't do that, right? Trend indicators, I have to say, are lagging and only work in trending markets. Now, statistically, it has been proven that markets only trend 30% of the time, which therefore means that on the long term, right, on the weekly and on the monthly, right, if you are doing a trend trading strategy, you will probably only be in the markets 30% of the time, and that will mean that 70% of the time you're either getting whipsawed out of the market, okay, getting a stop loss hit. So ideally, you're able to capture a huge chunk of profits from the trend so that it is able to offset your losses and hopefully leave you with a bit more profits, right? So trend indicators are lagging, okay, because they are all built on price. So as long as an indicator is built on price, most of the time it's lagging, right? So if you guys follow me, you guys will always hear me say that price action is king. Okay, all clear so far, right? So we move on to the top 5 popular trend indicators. So I have it over here on the screen. All right, I have 1, 2, 3, 4, 5. However, as I said at the start of the presentation, for me, I find it very hard to find 5 popular trend indicators, right? Anybody can argue with me on point 3, 4, and 5, right? So anybody can argue with me, okay? I will not say you're wrong, right? Yeah, like I said, debatably. Okay. However, I'm pretty sure none of you will be able to argue with me on points 1 and 2, right? Moving averages, all right, and the MACD, right? Moving average, convergence, divergence, okay, are the top 5 popular trend indicators, okay, are the top 2, sorry. And then I will cover a bit on parabolic stop and reverse, which is the Parabolic Sar, right? Bollinger Bands, okay, developed by Mr. John Bollinger himself, who has recently just retired. All right, he has stepped down from the IFTA board, okay, and of course there's also the Ichimoku cloud, okay. So we're hoping to be able to cover an entire topic on Ichimoku cloud on its own because it is such a complex indicator. All right, so keep your eyes out for that. Still in discussion. Okay, but let's move on. Okay, so I'm just going to show you guys a bit on how moving averages are structured. Okay, so let's look at moving averages. Now, there are many types of moving averages, right? Let me just change the color. Okay. So we have simple moving average, which is the most basic, right? Followed by the slightly more common ones like the EMA, the exponential moving average. All right, and then after that you have, of course, the weighted moving average, WMA. All right, so these are some of the moving averages that are a bit more commonly used out there. All right, I will show you how they are used later. Okay, just understand that simple moving average takes into account all the closing prices of the periods that you're looking at. Exponential moving average gives increasing weight to the most recent sessions. All right, weighted moving average gives different weights to the different sessions, with more weights on the more current one. Okay, so weighted moving average and EMA are slightly similar. All right. Okay, so let's say we have our chart over here. All right, we have the 12 periods. Okay, and then the prices are given over there. All right. So let's say now we want to calculate a 3-period moving average. So for simplicity's sake, we're looking at the EMA tree, SMA tree. Okay, so SMA tree. It's a bit tricky to write with the mouse, right? So how the SMA tree works is that it takes the closing prices of the first candle. Okay, the first candle. Okay, the closing price is at 20. All right. Give me a moment. I just need to see my slides. Okay, so it takes the closing price at 20, and then after that, the second candle is formed. All right, it takes the closing price at 19. All right, over here. Okay, you guys follow my pen. And then the third period is formed. It takes the closing price at 18. So once it has these 3 prices, okay, it takes these 3 prices for the SMA tree, they sum it up, all right, and they divide it by 3. Okay, simple arithmetic, right? And the average of this 3 gives you 19. So we see it plotted over here, this blue dot over here, right? It's plotted as 19. Now, the 4th candle, the 4th period happens, okay, the 4th period happens. So what the moving average, the simple moving average does is it drops off the 20, the first period, and it takes the next 3. Okay, so it's like a rolling window, right? It takes the second closing price, okay, 19 plus the third, okay, 18 plus the 4th, 17, and then they divide it by 3. Okay, and sorry, let me change this to pink so that you guys don't get confused. Why is it black? Okay, and then they take 19 plus 18 plus 17, divide by 3, you get the average is 18, and then it's plotted on the graph. Right? Okay, right. So and then let's say we go on to the next one, right? There's a 5th period that's being imprinted. Okay, let me just choose a nice color. Okay, so 5th period being imprinted, they'll take the last 3 period, they drop off the 2nd period, they take the 3rd period, 4th period price, closing price, 5th period closing price. It's like a rolling window, right? And then they'll calculate all this, they divide by 3, you get the average, okay, and it is 17. So once you have all the points, okay, they actually plot, right, and you actually get this black line over here, which is the 3-period moving average. All right, so it's a 3-period moving average. So the same thing is true for the 5th period, right? So the 5th period moving average, okay, the first data point is only calculated, okay, after the 5th period is shown. So let me just try to erase all drawing. So now we are looking at this 5th period. Okay, so let's say it's that simple moving average, 5 periods. All right, so what this does is it takes the closing price of the first 5 candles. All right, it takes all this, okay, and then it divides by 5. The idea is exactly the same, and then it gives you the average of 18. So it's imprinted over there, right? And then let's say another data point comes up. The 6th candle is imprinted. Okay, it takes the next 5, drops off the first one, takes the next 5 data points, divide by 5. You get an average. You get 17. All right, and yada yada yada. You plot it together on the chart. Okay, and together you guys get the 5-period moving average. Okay. So yeah, so this is how they get the simple moving average, right? So now we talk about the EMA, right? The exponential moving average. Okay, let's say we are still using the 3rd period exponential moving average. What this does is the exponential moving average gives the highest weightage, okay, to the most recent period. So let's say right now we are on the third candle, right? We're on the third candle. Maybe the exponential moving average will give this weightage 70%, right? 70%, and then it gives the second candle maybe 20%, okay, and then the first candle it gives a 10%, right? So it takes 10% times 20 plus 20% times 19 plus 70% times 18, you get the exponential moving average, okay, and then they plot it on the graph. Okay, so that is how exponential moving average works, right? Give me a moment. Really itching. Okay, so that's how the exponential moving average works. Now we look at the weighted moving average. Okay, same example for the 3 period. Okay, weighted moving average, really what it means is that the user actually has to set a weight for all the sessions, right? So maybe they just use the current session as 0.5. Okay, they give the weight of 0.5, and then after that they give the next weight 0.3. Okay, and then the final weight they give 0.2. Right, and then they just 0.2 times 20, 0.3 times 19, 0.5 times 18, and then they get the weighted moving average, right? The difference between weighted moving average and exponential moving average is that in exponential moving average, the most recent price data is given the highest, okay? It has to be given the exponentially high weightage. That's why it's called the exponential moving average. All right, I hope you guys are clear on this. It's pretty straightforward, okay? So that's how moving averages work. Let's move on to the next one, right? Very quickly, the MACD, moving average, convergence, divergence. So the MACD is really made out of 2 plots, right? So we have price, which has the MACD line, which is the 12-period EMA, and then there's also the 26-period EMA, right? So the MACD line, okay, is basically the difference between 12-period EMA and 26-period EMA, right? So let's say the difference over here, okay, is plotted below, right? So you get 1 point. The difference at this point, right? So let me just change the color. The difference at this point, all right, is plotted again. You get 0, right? Because the 12-period and the 26-period EMA is the same, so no difference. Okay, so over here the 12-period is higher than the 26-period, so you minus and you get the difference. It goes higher, right? So plotted, when all this is joined together, is plotted. Okay, you get the MACD line. Now the MACD line will be a bit jagged. So what the creator of MACD has done is to apply a EMA onto this MACD line, right? And it's the 9-period EMA of this MACD line to smooth it out. Okay, so you get the smoothing MACD line, right? Now, it was a bit tricky to put in the histogram, okay? But basically, MACD indicator, normally you will see a histogram, okay? There will be histogram, okay, or bar chart, depending on how you want to look at it, right? And then it swings, okay, around something like that. Okay, something like that, and then after that, histogram swing. Okay, but basically what the histogram is trying to tell you guys is that the histogram is really the difference between the MACD line, okay, and the signal line. So it's the difference, okay, it's the difference between these lines. All right, the difference between these lines, they will actually give you guys the histogram, and that is how we actually get the MACD indicator. Okay, in my opinion, the MACD indicator is a very powerful indicator, right? It is actually quite good, especially in the FX markets. Okay, I hope you guys are clear on this so far, the MACD and the moving average. Okay, so like I said, in the interest of time, I'm going to try to speed it up a bit more. Okay, now we move on to the debatable part of popular trend indicators. So we have the Parabolic Sar, right, which is the parabolic stop and reverse, right? So it comes in a parabolic shape, okay? So the stop and reverse is usually plotted as a dotted line, right? You have the charts, Okay, price is moving, and then you see all these dotted lines. Okay, and as price moves higher, you see that the dotted lines start getting closer and closer to price in a parabolic manner, right? So over here, when the trend has finally confirmed the breakout, okay, you see that the parabolic indicator has stopped and reversed to the other side and starts from far away from price, and then it starts getting closer and closer and closer to price. Okay, so that's really the idea behind parabolic stop and reverse. So when prices are above the stop and reverse, right, it means that the market is considered to be bullish. When prices are below the stop and reverse, the market is considered to be bearish. All right, so that's how the trend indicator tells us, okay, when when the market is trending. Okay, so you see the trend has, price has gapped down, right? Price has gapped down. Okay, so the Parabolic Sar has stopped and reversed to the other side, signaling that, hey, you know, perhaps the trend is changing. Okay, so when prices are below the Parabolic Sar, right, it really just means that we are bearish. Okay, when prices are above, it means we are bullish. All right. Okay, I realize. Just let me go back. Let me just go back to the moving average part. Okay, so very clearly, when prices are above the moving average, it means we are bullish. When prices are below the moving average, it means we are bearish. Okay, and as for the MACD, okay, the MACD, if the MACD is above 0, right, it means that we are in a bullish environment. All right, there is a build-up of bullish momentum in the markets. When MACD indicator, both the MACD and the signal line are below 0, it means there is a build-up of bearish momentum. We are in the bearish environment. Okay. Okay, so let's go to the next one, Bollinger Band. Okay, so Bollinger Band is really volatility and trend indicator that that shows you guys the volatility and trend in the market. Okay, so it looks like a very nice envelope. All right, you have prices, and then after that you have the middle line, which is really the 20-period moving average. Okay, John Bollinger set it to 20, and then you have the upper band and lower band. All right, the upper band and lower band, they are generally set to 2 standard deviations. Okay, so Mr. Bollinger has actually done his calculations, and he notes that, you know, 2 standard deviation is where 95% of the data, sorry, will actually fall within it, right? So how it works, okay, is when prices are below the middle line. When prices are below the middle line, it could mean that prices are trending lower, right? So we have to look at where price is in reference to the middle line, and we also have to look at the gradient of the upper and lower bound. Okay, we have to look at the gradient of the upper and lower bound. Now, Bollinger Band is also an entire topic on its own. Trading with Bollinger Band, knowing how to use it is also quite effective. Okay, right? So normally in the markets, all right, when price is testing the lower bound, the lower band, okay, it is especially when the band starts to show a squeeze, right? What I mean is when the band starts to narrow, okay, when the band starts to narrow, okay, and price is somewhere close to a lower bound, that is when you would really want to look for buys. Okay, and then normally you can buy with the first take profit at the middle band, and then after that, when there's a squeeze in the Bollinger Band, it tends to be followed with a very wide, the Bollinger Band will start to widen, right? Because volatility is increasing, price will push up significantly. Okay, so the opposite is true. When price is at the top part, okay, when price is at the top, close to the top of at the upper bound, all right, and you see that there's a squeeze, okay, you guys may look for shorts, okay, and with the middle line as your first take profit, okay, and then after that, once you take profit half of your position at the middle line, okay, you guys can actually write the squeeze lower with a trailing stop, right? So it's important for Bollinger Band to look at the slope of the bands. Okay, the slope of the bands and where price is positioned will tell you roughly which direction the market is trending, right? So when markets are above, okay, when price is above the middle line, okay, and you see the slope of the upper bound and the lower bound is sloping upwards, right, you guys can say with greater certainty that market is upwards trending. The opposite is true, right? When price is below the middle line, okay, price is below the middle line and you see the slope, okay, of the upper and lower downward sloping, okay, you can say with greater certainty that prices are downwards trending. All right, so that's Bollinger Bands, okay, so very interesting. Try to show you guys if there's time. All right, so I hope this is clear for you guys. So remember, it's 2 standard deviations. Of course, you guys can adjust for the standard deviation as well. All right, and next we will be looking at Ichimoku, right? So Ichimoku, I've changed the picture a bit because it is quite hard to. There really are a lot of components of the Ichimoku cloud indicator. Okay, a very fanciful indicator, right? But once you break it down, it is actually pretty easy to use. So Ichimoku indicator is really just a series of moving averages that is projected 26 periods into the future and 26 periods back into the past. All right. And the general idea is when price is below the cloud, it is downwards trending. So you can see when price is below the cloud. Let me just change the color. Okay, when price is below the cloud, it is downward trending. You can see this is the cloud, right? The red and green part. And then, of course, when prices are above the cloud, it is when we are upwards trending. Okay, and the thickness of the cloud, okay, is, imagine, I'm not sure if how many of you know how to fly planes, right? I don't, okay, but I do know that when a pilot flies into a thick cloud cover, right, there tends to be a bit of turbulence. So the thicker the cloud, okay, the more choppy the market will be within the cloud. And if the cloud is very thin, all right, if the cloud is very thin, it is easier for the markets to break through. So like if you guys look over here at the corner, the cloud is really thin. Okay, the markets actually broke right through, retested the cloud and went right down. Okay, so that is in general how to use Ichimoku cloud indicator, right? Just by looking at where price is, okay, in reference to the cloud. Below the cloud, downwards trending. Above the cloud, upwards trending. Within the cloud, sideways, choppy market. All right, so that is also another nice trend indicator for you guys. Okay, so any questions with regards to the indicators? Okay, I do have time, so I'm definitely going to go into the slides, into the charts. All right, if you guys have no questions, then I will go into the charts, okay, to show you guys how to incorporate, okay, each of the indicators. Okay, let me find it. Okay, no, not this. Okay, there you go. Okay, so any chart, let's just say we are looking at okay, so Parad, you're asking any setting parameters for Ichimoku cloud? No. Normally Ichimoku cloud, I just leave it to the default settings, right? That's good enough. All right, Tiano, you are asking, with all these indicators, which one is more accurate on which time frame? Okay, so that is a very subjective question, right? Again, it really depends on which time frame you are trading. All right. If you ask me, I think the one that really works the best for me is MACD, right? Combined together with moving average. All right. So for me, MACD and moving average works very well and on every time frame as well. Okay, but that's for me personally, right? For you, you will have to go and explore which one works with your style. All right. I'm not trying to evade this question, but It is really, really subjective. You can give two people the same charts, they can have two completely different bias, right? And having worked so long as an analyst, okay, I can tell you that any chart I can really show you guys that is bearish or bullish depending on how I draw the elements. Okay, so very quickly, let's just look at euro dollar. Okay, let's look at euro dollar. Okay, so let's start off with the daily, right? It's a nice time frame here. Yeah. Okay, let's put in the moving average. Okay, let's just ignore the MACD for now. There's one moving average here. Okay, so you can see when price is choppy sideways, right? When price is choppy sideways, I'll say price entered choppy market. Look, you can't really tell the trend, right? If you go short when price cross below the moving average, you're going to get stopped out, right? Over here, okay, example, if over here you go short, let's change the color for this. Okay, over here you go short, immediately you get stopped out, right? Because price reverse. And then after you go short again, right? Okay, not bad, you're profitable, but then you'll be stopped out if you go back long over here, right? Okay, so you probably only have like partial profits. Okay. However, when price is trending upwards really nicely, okay, let's say you go long here and price is trending upwards. Now we have the benefits of hindsight, right? So when price is above moving average, you can go long over here. You can actually ride the trend all the way up until it comes back here and then it cuts below and closes below, and then you can exit over here. So your profit, it will be something, give me a moment, your profit will be something like that. Over here, right? It will be here to here. This will be your profit. Okay, you won't get it right at the top. Okay, so you're still profitable, and hopefully this profit is enough to cover your losses over here. Okay, it is possible to also use multiple moving averages, right? However, I will caution against that, because moving averages at the end of the day, for me, they are lagging moving average. Okay, so let's use 21 and 55. All right, so 55, I'll use it as red. Okay, so you can see, right, when the moving average crossover, okay, this gives you a signal to go short, right? But then price is coming back up again, so you're probably short somewhere over here in this area. Okay, you're probably short here, right? But the question is, where will you take profit? If you're going to ride the trend, you're going to ride it all the way down. But what happens if something like that takes place, right? Something like that takes place. You go short over here, okay? You see the crossover happens, okay, and you go short over here, right? And price goes all the way down, but almost immediately price comes back up, okay, and takes you out. All right, and similarly, okay, over here it tells you to go short, but then price drops only for a bit and then it comes back up, right? Probably takes you out on your trailing stop. All right, very rarely, okay, you get something like that where there's a crossover and you go long over, you go long over here. You go long over here, right? And then you ride it all the way up, okay, until probably when price cross back over here. So you'll be stopped out over here, right? And let me just zoom out. Your profit will be something like at this point to somewhere at this point. And you close out. Okay, so this is the daily. So you're riding the trend. You're getting around 663 pips, right? Okay, so this is just an example. Okay, and very quickly, let's look at the MACD. Why I say the MACD for me is the most accurate. Okay, I'm just gonna take out the MACD and show you guys. Okay, so the MACD for me is more accurate because every time the MACD crosses zero, right, it tells me that price is in a bullish environment and we should look to go long, right? So over here, I'm just gonna draw the lines, the vertical lines. Where are my vertical lines? Okay, over here, moment, right? MACD, both the MACD and the signal line has crossed above the zero. So I will actually go long here. And as long as they have not crossed back below 0, I will not exit. Okay, I'm just saying an example. Okay, so now over here they have both crossed back below 0, right, at this area. So I would actually enter at the close over here. All right, and then you get out at the close over here. 683 pips. Okay, ideally with the benefit of hindsight, about the same as using double moving averages. Okay. Now the thing is, okay, when the MACD is choppy around the 0, okay, around the 0, that is when I would not enter, okay, because it just means that we are in a sideways market. All right. So one thing that the MACD is better than the moving average is that it is a bit more sensitive to the changing in the bullish to bearish momentum or bearish to bullish momentum. All right, so that's for the MACD. Okay, and of course now let's look at the Parabolic Sar. Okay. So a Parabolic Sar, you can actually set just leave it to default, okay, and make it a bit thicker so it's easier for you guys to see. I want the circles. Okay, so it's something like that, right? Now, Parabolic Sar in a sideways market is just going to take you out as well. Imagine you go long, right? You see price go something like that, and then you go long, okay? But immediately when you go long over here, immediately what happens? Okay, the Parabolic Sar stops and reverses and tells you that, oh no, price is now in a downtrend. So you will probably exit nearly the same candle after that, okay? And you'll lose out money, all right, in terms of commissions and swaps. Okay, Parabolic Sar works really well, right? When it's really the furthest away from price. So you'll probably enter somewhere over here, okay? And then as price trends, okay, you realize that Parabolic Sar gets closer and closer to price. All right, when it's quite close over here, you probably exit at this candle, okay? And then wait for it to stop and reverse, right? You wait for it to stop and reverse. So you probably have a chunk of profit, okay, about 360 pips. All right, so for me, the Parabolic Sar is not as good as the MACD, right? So just showing you guys how it works. All right. So after a Parabolic Sar, what do we have? Okay, we have the Bollinger Band, right? Okay, so let's include the Bollinger Band. Okay, so we have the Bollinger Band over here. Look, like I said, okay, the Bollinger Band is a very interesting indicator, right? So imagine price has now broken below, okay, and it's testing the low, right? Testing the lower band. I didn't change any settings. Okay, it is the natural standard deviation of 2, and the middle line is 20. Okay, it's using the closing prices. All right, I've got a question. Jeline, you're asking if there's an e-certificate. I'm not sure what you mean by an e-certificate. So yeah, maybe while I wait for your reply, I'll just continue with this. Okay. So look at this area here, right? I just want you guys to look at this area here. Okay, so price is near the lower band, right? And look at how narrow it is. Okay, so price is narrowing, right? Now, as price starts pushing higher and the band starts widening, okay, you realize that the upper band is steeper than the lower band. Okay, this tells us that prices are going to explode higher. All right, every time that the Bollinger Band squeezes, right, it is actually telling us that it's poised, all right, for a big move, right, for a big move. So over here, you can actually ride it all the way up until it comes back down, where you see there's a squeeze again. Okay, how do I get rid of this? Yeah, I have no idea how to get rid of this. Okay, let's just use $, again on the daily and Bollinger Band. All right, so you can actually ride it all the way up, okay, until price crosses below the what do you call that, the middle line. Okay, so what you guys can do is when it crosses over, okay, it reacts off this and crosses above, and you guys can actually enter somewhere over here, ride the squeeze upwards all the way until it cuts back below. It's about 528 pips. Okay, so Bollinger Band is very interesting. Every time prices squeeze, right, you can see there's a narrow band. Okay, when it's narrow, it's telling you that markets are really sideways. All right, and after a period of being narrow, it tends to explode in a very big manner. Right, it tends to explode in a very big manner. Just look for the side that is more steep than the other side, and that is where price is heading in that direction. Okay, so that's the Bollinger Band for you. All right, and finally, of course, there is the Ichimoku. And so as I mentioned earlier, Ichimoku, okay, a bit hard to see over here, but really, I don't change any settings. It's really the default. But look at it. When the Ichimoku is so choppy, okay, what I suggest for beginners, okay, is to just look at the cloud. Okay, just look at the cloud. That's all you need to do. Okay, you just need to look at the cloud. Okay, when the cloud is thin and price is chopping around the cloud, it's really the market being sideways, right? However, when there's a thick cloud and market breaks out above it, okay, you know that price is starting to trend in that direction. All right, price is starting to trend in that direction, and you can actually exit when price closes back below the cloud. So you'll probably enter, okay, on the second candle close above the cloud when it broke out of a thick cloud like that, and then you probably exit at the close, okay, when price closed back inside the cloud, okay, signifying that, you know, conditions have changed, right? But as long as we're above the cloud, there's the trend that we ride. So this will work out to be about 607 pips, okay, on the daily trend. Okay, so you realize that again, when the cloud is thin, something like that, you probably stay out of the market, okay, and you probably may not even get in on this move because the cloud is so thin, right? But now that we have broken out of a fairly thick cloud, okay, and price is below, we can say with greater certainty that, you know, the euro dollar is probably starting to trend downwards as well. All right, so this is really how we incorporate indicators into our charts and our analysis. Okay, now to wrap all this up, I have just some things that I really want to share with you guys to take note of when you incorporate indicators in your analysis. Okay, first and foremost, it's never good to just rely on one indicator alone. Okay, having said that, okay, it's also not good to rely on too many indicators. Okay, statistical studies have been shown that having more than 3 indicators, all right, traders will start seeing diminishing marginal effectiveness. Okay, there'll be too many mixed signals in terms of the indicators. You'll be confused as to which indicator to follow. So the max, just keep it to 3 indicators. Okay, indicators also have to be taken into account as a whole. So it's a holistic picture. You don't just look at one indicator alone or 2 indicators alone and say, okay, look, price is above, it's upwards trending, let's go for a long. Or price is below, it's downwards trending, let's go for a short. Right? You try not to do that. Okay. And remember that at the end of the day, trend indicators are lagging indicators. So in the examples that I showed you guys, it's due to the benefit of hindsight. That's why I can decide where I want to enter. But in real life, you guys will probably have to wait quite a bit for confirmation before you guys enter. So at the end of the day, lagging indicators are built upon price. And so I want to say price is king, right? So always follow price action. Okay. So this is just really sum it all up, just some warning points for all of you. All right. Okay, so Gerald, you're asking about the natural moving average. I don't really have time to cover the natural moving average. It will take quite a bit, and I don't really want to leave you guys hanging, right? But so very quickly, okay. The natural moving average is basically using EMA, all right, that follows Fibonacci numbers. Okay, so you're just using Fibonacci numbers. So Fibonacci numbers, normally I'll start off with either 21, 34, or 55. So let's try 34, something like that. And I try to see, okay, where when the markets are trending, which moving average holds the price nicely. So the idea is for price to tap and react, tap and react, tap and react. I don't like to see a huge space like that. So maybe 34 is not the best for euro dollar, maybe 21, okay, and it's something like that. Okay, so I want to see something like that. So it taps and react, taps and react, taps and react. It holds the trend very nicely, and you can see in an uptrend is holding it very nicely again as well. So what this tells me is that 21 is the natural moving average of euro dollar on the daily. Okay, so every time price comes back to the 21 moving average, okay, so something like that. You see right now price comes back to 21 moving average, it should react and drop as well. Okay, so that's in essence how to use the natural moving average of the chart. Okay, okay, last question, Peter, wondering about effectiveness of TIs, shorter time frame, day traders, example so far multi-day. Oh, okay, effectiveness of trend indicators in a shorter time frame. Last 3 minutes, let's go down to say maybe half an hour, right? So when there is more noise, okay, when there is more noise, the indicators tend to jump around a lot. It's a bit more choppy, all right. However, they still work, all right. They still work because trend indicators, like I said in the very first slide, a trend is really subjective. It depends very much on the trader's definition. If you are trading the 30 minutes, look, this is a downtrend. Why? Because price makes a series of lower highs and lower lows, right? So we are in a very clear downtrend. Okay, so trend indicators definitely also work on the lower time frame. All right, so Peter, I hope that answers your question. Okay, so with that, we have come to the end of today's presentation, right? Sorry if this feels a bit rushed. I hope it was deep enough for those who are experienced, yet easy enough to grasp for those who are just coming back to trading or relatively new. Okay, if you have any questions and answers, all right, you can email support@fpmarkets.com. Otherwise, if you would like a recording of this, you can also try asking the support@fpmarkets.com. But for all upcoming webinars, you can actually go to fpmarkets.com/trading-webinars/ and that should bring you to the page that I showed you guys right at the start of the webinar. All right, which is in essence over here, right over here. Okay, so thanks everyone for your time. Really appreciate it. Wish you guys all the best. Trade safe, stay safe, and I'll catch you guys again.